Let me tell you about my Aunt Linda. She turned 65 last year and was excited to finally get on Medicare. She'd done everything right. Saved diligently, planned her retirement, and thought she understood the basics of Medicare costs. Then she got a letter from Social Security that absolutely stopped her cold. Instead of paying the standard $185 per month for Medicare Part B, she was being charged $259 per month. That's an extra $888 a year, and she had absolutely no idea why. Here's what caught her off guard completely. 2 years earlier, when she was 63, she sold some stock to help pay for a kitchen renovation. That single transaction pushed her income just over a threshold she'd never heard of, and now she's paying the price, literally, in higher Medicare premium. I'm going to show you exactly why age 63 is actually more important than age 65 for Medicare planning. And most importantly, how to coordinate your income events and Roth conversions so you don't get blindsided like my Aunt Linda did. Let's dive in. Chapter 1. What IRMAA is and why most people have never heard of it. IRMAA stands for Income-Related Monthly Adjustment Amount, and it's essentially a surcharge that gets added to your Medicare Part B and Part D premiums if your income exceeds certain thresholds. Now, most people know that Medicare isn't completely free. There's the standard Part B premium that everyone pays. In 2026, the standard premium is $203 per month per person. But here's what catches most people off guard. If your modified adjusted gross income, or MAGI, is above certain levels, you don't just pay the standard premium. You pay the standard premium plus an IRMAA surcharge. And these surcharges can actually be substantial. Let me show you how this works with the 2026 number. For a married couple filing jointly, if your 2024 MAGI was at or below $218,000, you pay the standard premium. But if your 2024 MAGI is even $1 over $218,001, you jump into the first IRMAA tier. Now you're paying $284 per month for Part B. There's also an IRMAA surcharge for Part D, which is your prescription drug coverage, which will cost you an additional $14.50 per month. For a married couple where both are on Medicare, crossing that $218,000 threshold by even a single dollar means you're paying both an extra $1,148 per person per year in surcharges. That's almost $2,300 for a couple annually based on income from 2 years ago. And it gets worse as your income increases. There are actually 5 IRMAA tiers. And the highest tier, which is an MAGI of $750,000 or more for a married couple filing jointly, you're paying $649 per month for Part B and an additional $91 per month for Part D, which comes to an extra $8,576 per person per year in total premiums. For a couple, that's just over $18,700 annually in additional Medicare premiums. Chapter 2, the 2-year Lookback Trap. Why your age 63 income determines your age 65 Medicare costs. Now here's why this gets really tricky. And this is what caught my Aunt Linda completely off guard. Medicare doesn't look at your current year's income to determine your IRMAA. They look at your income from 2 years prior. Let me say that again because it's so important. Your Medicare premiums in 2026 are based on your adjusted gross income from 2024. Your 2027 premiums will be based on your 2025 income. This is called the 2-year look-back rule. When you turn 65 and first enroll in Medicare, Social Security is going to pull your tax return from when you were 63 to determine your premiums. When you're 66, they'll use your 64 return. This is why ages 63 and 64 are when the biggest IRMAA mistakes are made. Let me show you how this played out with my aunt. She sold a bunch of NVIDIA stock that she had built up significant unrealized gains over the years and turned those unrealized gains into realized gains without thinking through what this would do to her Medicare costs. Remember, IRMAA uses the 2-year look back. So the income you generate at 63 determines your Medicare premiums at 65. My aunt didn't know that until the bill arrived. So she found herself paying an extra $374 a month in Medicare premiums. It's roughly $4,800 a year in additional costs she wasn't expecting based on income that didn't continue. It was a one-time event. And because of how the look back worked, she's paying that for at least 2 years. The frustrating part is that this was avoidable. And here's the thing. If she had sold the stock over 2 years or done it before turning 63, she would have avoided this entirely. So I tell people that age 63 is actually more important than age 65 when it comes to Medicare planning. By the time you're applying for Medicare at 65, your fate is already sealed for at least the first year. You need to be thinking about IRMAA 2 years before you enroll. Chapter 3, the age 63 rule most advisors get wrong. Why planning starts earlier than you think. Believe it or not, I still see a lot of financial advisors get this wrong. They know about IRMAA, they forget about the 2-year look back. It's like closing the barn door after the horses have already escaped. There are actually 3 distinct windows to remember when it comes to IRMAA planning. The first window is ages 60 to 62, or really any time before you turn 63. This is your golden window for big income events. This is when you want to do things like Roth conversions, or selling investment property, or exercising stock options, selling a business, taking a big bonus, or maybe a big severance package. Because these income events won't affect your Medicare premiums when you turn 65. Let's say you retire at 62. Your income drops significantly because you're no longer earning a salary. This creates what planners call a tax valley, when you're in a lower tax bracket than when you were working. And you're not yet taking Social Security, or you're taking your required minimum distributions. Those don't happen until later. This is the perfect time to do aggressive Roth conversions. You can convert $50,000, $100,000, or maybe more from your traditional IRA to a Roth IRA. Yeah, you're going to pay taxes on those conversions now, but you're paying them at a lower rate because you're not working. The second window is ages 63 and 64. This is your precision window. You still have planning opportunities, but now you need to be very, very careful. This is where you need to run detailed projections of your MAGI and decide exactly how much room you have under the IRMAA thresholds. It's often a good idea to wait until November or December of the year you turn 63 to do any Roth conversions, because by then you'll know what all your other income for the year is going to look like. Your wages, if you're still working, your dividends, your interest, any capital gains you've realized. Then you can size your Roth IRA conversion to fill up that bucket to stay just below the IRMAA threshold that you want to stay under. If you're 63, married filing jointly, and by November your projected MAGI for the year is $190,000, you have room of about $28,000 for Roth conversions before you hit that $218,000 threshold. Now the third window is age 65 and beyond. You're on Medicare now. Your income still matters because it still affects your future IRMAA premiums 2 years out. But the immediate crisis of those first year premiums is past. Now the focus shifts to managing your required minimum distributions, coordinating Social Security, and maintaining the IRMAA bracket that you're comfortable with. Chapter 4, how to avoid IRMAA surprises by coordinating income events. So now that you understand the look-back rule and the importance of planning before you turn 63, let me walk you through specific income events that can trigger IRMAA and how to coordinate them intelligently. First, let's talk about the big ones, the income events that can really spike your MAGI and push you over an IRMAA threshold. Number one is selling a home. If you sell your primary residence, you can exclude up to $250,000 of gains if you're single, or $500,000 if you're married filing jointly, assuming you meet the ownership and use tests. But any gain above that exclusion is fully taxable and counts towards your MAGI. If you're selling a second home or an investment property, the entire gain is taxable. Number two is Roth conversions. I've talked about this already, but it's worth repeating. Roth conversions are fully taxable in the year you do them, and they increase your MAGI dollar for dollar. The right strategy is to front load conversions before 63 and then be very measured and strategic with those conversions at 63 and 64. Number three is capital gains from selling investments, and this is what got my Aunt Linda. If you have highly appreciated stock, mutual funds, or other investments in a taxable brokerage account and you're thinking about selling, pay attention to the timing. Now, this doesn't mean you should never sell investments once you're close to Medicare. It means you need to be intentional. Maybe you spread the sale across multiple years to keep your gains below the threshold, or you do the bulk of the selling before 63. Or potentially you use tax loss harvesting, selling positions that you want to offset with a loss to keep your net capital gains lower. Number four, things like bonuses or severance packages or stock options exercises. If you're still working at age 63 or 64 and you're offered a large bonus or a large severance, understand it's going to count towards your MAGI. If possible, negotiate to defer the payment to a year that won't affect Medicare. Same thing with exercising those options. If you can, do it before 63 or wait until after 64. Number five is business sales. If you're a business owner planning to sell your business, the timing relative to age 63 can have a massive impact. A large business sale can generate hundreds of thousands or even millions of dollars in taxable income, which could absolutely put you in the highest IRMAA tiers. If you can time the sale for age 60, 61, or 62, you'll pay the income taxes, but you'll avoid the IRMAA surcharge. Now, let's talk about required minimum distributions, or RMDs. In your 70s, you're required to start taking distributions from your traditional IRAs and 401ks. These distributions are fully taxable and count towards your MAGI. For many retirees, RMDs are the single biggest IRMAA trigger later in retirement. This is where that early Roth conversion strategy really pays off. If you convert a large portion of your traditional IRA to Roth before you hit Medicare, your RMDs starting in your 70s will be much smaller, which means your MAGI stays lower, which means you stay in a lower IRMAA bracket or avoid it entirely. Finally, let's talk about Social Security. Up to 85% of your Social Security benefits can be taxable depending on your income, and the thresholds are laughably low. The taxable portion count towards MAGI. One strategy some people use is delaying Social Security until 70 to create a low income window in their early 60s. That low income window is perfect for Roth conversions before age 63. So here's the coordination strategy in a nutshell. In your late 50s and early 60s, before age 63, you want to be aggressive. Roth conversions, realizing capital gains, selling properties, selling businesses. Get the big taxable events done. Then at 63 and 64, you can shift to precision mode. Chapter 5, the mistakes to avoid and how to appeal it if you get caught. Let me wrap up by talking about the common mistakes I see people make with IRMAA and what you can do if you get hit with a surcharge that you weren't expecting. So the first mistake, assuming that charitable contributions will reduce your IRMAA. A lot of people think, well, I gave a lot to charity, so my taxable income is lower, so I won't have IRMAA. That's not quite how it works. IRMAA is based on your modified adjusted gross income, which is calculated before itemized deductions like charitable contributions. So giving more to charity generally won't lower your IRMAA. The exception there is if you're over 70 and a half and you do a qualified charitable distribution or QCD directly from your IRA to a charity, that doesn't count as income at all. So it can help keep your MAGI lower, but standard charitable deductions don't help with IRMAA. Mistake number 2, not coordinating with your spouse. IRMAA is based on your combined MAGI. If you're married filing jointly, but each person on Medicare pays their own surcharge. So if you and your spouse are both on Medicare and your combined income pushes you into an IRMAA tier, you're both paying the surcharge. This is why for married couples, the cost can double. The third mistake is not updating your projections every year. Your MAGI can change year to year based on things like market performance and dividends, interest rate, and unplanned income events. You need to run a fresh MAGI projection every year, especially at ages 63 and 64, to make sure you're not accidentally crossing that threshold. Now, what if you do get hit with an IRMAA surcharge and you think it's unfair? You do have the rights to appeal, but the grounds for appeal are pretty limited. The life-changing events that qualify include things like retirement or a loss of an income-producing property, loss of a reduction of pension, death of a spouse, marriage, or divorce. So if, for example, you retired in 2024 and your income dropped significantly from what it was in 2023, you can file for an appeal and potentially get your IRMAA reduced or eliminated for 2025 and 2026. But here's the key. You generally can't do an appeal just because you chose to do a Roth conversion or sold some stock. Those are considered voluntary income events. The appeals process is designed to help people whose income has genuinely dropped, not people who made a financial planning decision that happened to trigger IRMAA. So the bottom line is this. The best defense against IRMAA is planning ahead and understanding the 2-year look back. Know that age 63 is the critical year, not 65. Front load the big income events before age 63 if you can. My Aunt Linda had known all this, she could have done the kitchen renovation a year earlier and saved herself over $4,000 a year in Medicare premiums. For a lot of retirees, that's not pocket change. That's several months of groceries or a nice vacation. So here's what I want you to do. If you're within 5 years of Medicare, anywhere from age 60 to 70, I want you to run an MAGI projection for this year and next year. Figure out where you stand relative to the IRMAA thresholds. If you're close to a threshold or you're planning any large income events like Roth conversions, selling property, or taking a big distribution, map out the timing. And if you're not sure how to do that, or you want help building a comprehensive tax and Medicare strategy, that's exactly what we do. You can schedule a free consultation with our team by clicking the link in the description below. Let's make sure you keep more of your hard-earned money where it belongs, in your pocket.